As many economists predicted, the Bank of Canada has held its policy interest rate at 2.25% once again.
Our monetary policy decisions are focused on keeping inflation close to the 2% target while helping the economy through this period of structural change. Governing Council judges the current policy rate remains appropriate, conditional on the economy evolving broadly in line with the outlook we published today.
That's Bank of Canada Governor Tiff Macklem at his most recent news conference.
With heightened uncertainty, we are monitoring risks closely. If the outlook changes, we are prepared to respond.
To help us break down what exactly this means for the bigger picture, we're joined as always by Scotiabank's Chief Economist Jean-François Perrault. He'll speak with Natalie Nanowski about what factors led to this decision, what this tells us about the state of Canada's economy, and what we could see in terms of interest rates later this year. I'm Armina Lagaya, and this is Perspectives. Now, here's Natalie Nanowski.
Hi, JF. Thanks so much for joining us today.
Thanks. It's a pleasure to chat.
Okay, so right off the top, we're recording this around noon on Wednesday. It's right after the Bank of Canada announced its latest rate decision. Let's start with what that is. What's the big headline?
Well, the big headline is the Bank of Canada did exactly as we all expected and exactly as they telegraphed they were going to do, which is to keep rates unchanged. Not a surprise, and I think the right thing for them to do at this point in time.
Okay, so what's going on with the economy that led the bank to hold?
There's so many things going on that are kind of influential on the outlook. There's, U.S. trade policy uncertainty, Canadian inflation developments, obviously what's happening with the domestic economy here. But I think from the Bank of Canada perspective, what we have is an economy that's been a little bit softer as the year progressed than, of course, we were thinking, a year ago, largely because of the trade uncertainty. But at the same time, inflation in Canada is just a little bit above where the Bank of Canada would like it to see. So there's been this tension all year long between, or all of last year, because we're in 2026 now, between, is growth sufficiently weak that the Bank of Canada should be cutting interest rates, or is inflation sufficiently high that the Bank of Canada should not cut interest rates? So they cut 50 basis points last fall to provide a little bit of a kick to the economy in relation to the fact that the economy was a little bit soft, even though inflation was a little bit problematic. And I think with that 50 basis points of recalibration, that's enough for them to just sit and wait and see how the economy evolves and whether or not that was the right decision, whether or not they need to do more or less as time goes by.
So Governor Tiff Macklem said a few times during his press conference today that uncertainty around our forecast remains unusually high. And he used that word uncertainty a few times. So how difficult is it to plan when there is so much uncertainty?
They spend a lot of time thinking about the economy, what to do about it. We do that as well. Households do the same thing, businesses do the same thing. It's just an environment where there's a lot of things coming at us. And, those things, typically speaking, are, somewhat discombobulating. What do we make of the most recent Trump announcement on trade policy, on whatever it might be? Is it serious or not? Do we incorporate that in our forecast? Do we not? So there's a tremendous amount of noise that makes it very difficult to come up with a view that is bulletproof to what might be announced next week or 2 days or by the time this call is over. So that environment, of course, that's unprecedented. I mean, we've lived through it over last year, but that remains an unprecedented environment. And, the first 3 weeks of the year, I think, are a perfect recap of that. Just a range of things in the first few weeks of the year that remind us that we're in a world where, you kind of have to expect the unexpected. And that means that you can have less faith in how you think about the world and where you think things are going to go, because that could change a week from now based on how somebody decides they want to engage with us or the rest of the world. So that makes it really complicated because it's not trying to work through macroeconomic shocks. So what is likely to happen to commodity prices if, growth is stronger or weaker? What happens if consumers spend a little bit more or less? This is largely the result of an individual making a judgment on something and us and others having to think about what that means. So it's a very different type of uncertainty that we typically experience in the economy and in markets.
So given all this uncertainty, everything that happened in the past year and everything that's happened just in the beginning of this year, how is the Canadian economy doing?
Well, that's actually been surprisingly resilient. Growth in 2025 was somewhere between 1.5 and 1.7%. We'll nail that down in the next few weeks as we get more data. Certainly this time last year when the president came out with his initial kind of tariff threats on Canada, 25% and those kinds of things, there was a real chance that we'd have a recession in 2025. And of course, we didn't have that. We had an economy that performed better than expected. 1.5 is not screaming, robustness, but it certainly is not screaming recession as well. So you've seen, strong employment growth in the second half of last year. In fact, in Canada, we created 190,000 jobs since August. That is more jobs created in Canada compared to the U.S., not adjusting for population, just in raw numbers. So the job market, even though the unemployment rate rose a little bit, there's still some kind of resilience there. Wage growth has been strong. Markets have been strong. That's allowed households in Canada and the U.S. and elsewhere to spend some of that wealth. We've kind of gotten a little bit used to the uncertainty. So as the year progresses, folks are a little bit more comfortable with taking decisions or, doing something with their money, whether it's businesses or individuals. So despite all that noise, despite the uncertainty, despite the challenges of figuring out where things are going to go, we look back to 2025 and say, it wasn't as bad as we'd feared. And that, speaks somewhat confidently to what we're in for in 2026. I repeated the same. Again, we're starting off with lots of uncertainty and we worry about that, but the underlying dynamics are not as poor as we'd been concerned about. So we're coming into 2026, somewhat perversely, with a bit of optimism with respect to how we're going to be able to handle the next few months, next few quarters, and the uncertainty associated with that.
So coming into 2026 with some optimism, initially our Scotiabank's economics team, your team, said that we should expect a little bit of growth in the second half of 2026. Is that still what you're predicting?
Yeah, the uncertainty is clear and present. I mean, I don't know how many times we're going to see uncertainty on this call, but that is the defining feature of the world that we're in. And we know Canadians are still struggling to adjust with that. We know there's some uncertainty with respect to the CUSMA review that we are going through with the Americans at present. And some folks are worried that might not get renewed. And, there's a natural kind of dampening effect of some of those things on the economy. But as we progress through the year, the uncertainty with respect to CUSMA will resolve, hopefully. And hopefully we still have a deal. That's what we think. As the federal government and the provinces work to transform the economy and has set in place a range of programs to stimulate investment, we expect those to start kicking into 2026 gradually with more of an impact in the second half of the year than earlier in the year. And of course, there is an expectation that this uncertainty that is a drag fades over time. Maybe that's not a realistic expectation, but that's certainly an expectation. So all those things suggest that as we progress into 2026, that, we hand off into a little bit more of a kind of a dynamic environment, one where economic factors are more important drivers of economic decisions than worries about what might happen in 2 hours, for example.
So, we're here, we're in 2026. And as the year unfolds, I think one of the things that Governor Tiff Macklem said is that monetary policy is focused on keeping inflation close to the 2% target while helping the economy through this period of structural adjustment. What is that structural adjustment that we're dealing with?
So the idea pretty simply is, we have been, Canada has been, of course, uniquely exposed to the U.S. for decades now. We're deeply integrated with that economy. We're going through a period of time where the Americans are trying to deintegrate themselves from the global trading system to some extent. And that means, altered relationships with Canada economically. And that transformation is, challenging. We don't know how that's going to work exactly. It could be that it leads to a little bit weaker growth in the short run. It could be that it leads to stronger growth as we do that. But that's an element of uncertainty. So when the governor talks about this, the cost of restructuring or the structural transformation, that's what he means. It takes a little bit of time, takes a little bit of effort on the part of businesses, on the part of governments. So you're probably going through a period of a bit weaker growth flowing from that. And that's potential growth, so structural weakness to some extent. That's not what he said about that today is not new. Like that has been something that Canada has been worked through basically over last year. That's certainly what the Prime Minister has been focused on in terms of the transformation agenda and building Canada. Like it's recognition that we need to do things differently. And as you do that, they're kind of what we call adjustment costs. Things are, going from one state to another, things are going to be a little bit harder for a while. And that's what we've experienced in Canada in 2025. And we're going to experience a little bit of that in 2026 as well as that transformation occurs.
So given today's hold and also the structural adjustments that the Canadian economy is going through, what does all of this mean for the average Canadian?
The good news, I suppose, is that it seems, I think it depends on your perspective whether it's good news or not, but the good news is I think we can count on some rate stability for a while. So the Bank of Canada has made it pretty clear they don't think they need to cut interest rates any further if the outlook evolves as they expect. And they've got a pretty weak expectation, so the bar is, really quite high for them to do something different with rates than what they're saying. But as the year progresses, it's our view that as the economy strengthens, that maybe the Bank of Canada will need to recalibrate its policy a little bit, that raise interest rates in the second half of the year as growth improves a little bit, as inflation in Canada still, from our perspective, is a little bit of a challenge. We're still not at 2%. We're kind of in the 2.5% range. So it suggests to us that we just need a little bit of recalibration. And for Canadians and our clients, obviously, if that were true, if that's actually what happens, then you could look to, higher interest rates at some point in the year. There are puts and takes against that, obviously, and uncertainty being a key one of those things. But it does seem that, as the year progresses, it's safer to bet on the possibility of higher interest rates rather than the possibility of lower interest rates from our perspective.
This year is the year of a large amount of mortgage renewals, right? So for Canadians right now, what does that mean for those looking to maybe get into the housing market or to renew their mortgages?
Yeah, that's a really good question. And it's one in which the Bank of Canada actually isn't probably the most important factor here. When you think about your mortgage, obviously, if you get a variable rate mortgage, a short-term mortgage, that's priced off the Bank of Canada rate. But if you go longer with 3 to 5 year mortgages, those are priced off in part what happens with the Bank of Canada and expectations around that, but also what happens in the US and US funding costs. And here, it's pretty clear as you look at what the Americans are doing to themselves in terms of the amount of debt that they're issuing, in terms of their rewiring of the world, that their uncertainty in the US is pushing longer term borrowing costs up. We'll see how much they go up, but our expectation is that, that say 10-year borrowing costs, 5-year borrowing costs are probably going to rise 20, 30 basis points between now and the end of the year. In fact, they've increased pretty significantly in the US over the last week or so. And that matters because if those US rates go up, basically the way the world works is, the US rates are kind of the base rate against which other rates are evaluated. So if US long-term interest rates go up, chances are Canadian long-term interest rates go up. And if Canadian long-term interest rates go up, chances are mortgage rates go up at the same time. So our anticipation is that the further you wait, at this point, it seems, the further you wait to, renew a mortgage, get a mortgage, if you're thinking about getting a longer term mortgage, the chances are that mortgage is going to be a bit more expensive for you, say, in the second half of this year, as opposed to now or the next few weeks from now. So it's just a bit of a nuanced message. If you're getting a variable rate mortgage based off the Bank of Canada, if that's your intention, you're probably fine to take your time. If you're trying to get the best possible rate and you want a fixed rate mortgage longer term, maybe it's better to move earlier rather than later on that.
So in his press conference on Wednesday, Governor Tiff Macklem pointed out that he expects business growth to improve in the second half of the year as businesses adjust to the new reality. What's the outlook? What's our Scotiabank outlook in terms of business rate investment?
Yeah, so we know that's a challenge because businesses, of course, are responding to the uncertainty. If you don't know if we're going to have a trade deal with the Americans in 6 months, then that changes how you think about capital deployment. It creates some uncertainty. So we see that. We see that very clearly in the data. Canadian firms, while they are more optimistic about the way forward, largely because the policy environment in Canada is adapting to one that is more supportive of investment, the reality is that in the short run, that's not translating into very significantly different business behavior, and that's understandable. We think that will fade over time, that those concerns, as, again, we get accustomed to the uncertainty, we kind of, realize that some of the risks don't materialize, some of the threats don't occur, don't materialize as well, that those government attempts to transform the economy through various types of supports and trade deals and investment deals, that we expect as the year progresses, again, a pickup in business activity, principally on the investment side. And of course, with that comes stronger employment growth and stronger GDP and a range of very good things that occur when businesses are more dynamic in the economy.
To end everything off today, what are the main takeaways for Canadians from this decision?
The main takeaway from an interest rate perspective is that the Bank of Canada is on hold for a while. It's debatable as to whether the next move is an increase. We think that might be. There are a few people that think that at present. But certainly over the next several weeks, probably several months, we expect no changes in the Bank of Canada. And the governor's been pretty clear about that. But that Bank of Canada decision is just one of the many things that are influencing how people are engaging with the economy. Uncertainty's high. We're dealing with statements on a daily, hourly basis The challenge for Canadians and for others outside of Canada is figuring out which of these things is meaningful or not. And so far, most are meaningless, but some are meaningful once in a while. So kind of looking through the noise to make informed decisions about your business, about your household finances is going to continue to be a challenge for a while. And of course, associated with that, this uncertainty in the US is the possibility or indeed the likelihood that as we progress through the year, the longer term borrowing costs are likely to rise a little bit.
Yeah, a lot of things to keep in mind as we go through the rest of 2026. And it seems like uncertainty is the key word in all of this.
It's already clearly the word of the year.
Thanks so much, JF.
Well, thank you.
I've been speaking with Jean-François Perrault, the chief economist at Scotiabank.
The Perspectives podcast is made by me, Armina Lagaya, as well as Ned Kelly and Natalie Nanowski. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.